Get ready, everybody, because today we're going deep, diving into the world of corporate loans. We're talking about huge sums of money, big risks, and this absolutely critical thing called liquidity. You know how we always say cash is king? Well, when it comes to lending to corporations, liquidity, that's the kingmaker.
And what's so interesting here is just how different these big corporate loans are from what we usually think about. It's not like just hopping on your computer and comparing interest rates for a car loan or a mortgage.
Right, it's a whole other ballgame.
It is. We're talking about deals so big they can seriously make or break banks. I mean, they can even impact entire economies.
Yeah, you're not kidding. I was just reading about what happened back in 2018. This big bank in India had to write off billions, like billions with a B. And it was all because just a tiny number of these corporate loans went bad. Just goes to show you the stakes we're talking about. But before we get too far ahead of ourselves, can you remind us why liquidity is so essential in this world of high-stakes lending?
Think of liquidity like the oxygen that keeps banks alive. They need cash, or at least assets that they can quickly turn into cash, to be able to meet their obligations. Now, add in these massive corporate loans, they're not like your typical mortgage.
Which you can easily sell or trade.
Right. Corporate loans, they often end up just stuck on a bank's balance sheet.
They're illiquid.
Exactly. They are. It's like having a diamond when you're trying to pay for groceries. Yeah, it's valuable, but good luck trying to use it at the checkout. And that's where things get really risky for banks.
So if a bank needs cash in a hurry to cover something else, those illiquid loans, they become a huge problem.
Exactly. And that is liquidity risk in a nutshell. And Silicon Valley Bank is, unfortunately, a perfect example of this.
It's true. Their collapse was like this huge wake-up call. It showed us all what can happen when things freeze up and that liquidity dries up.
It really was a perfect storm. You had all these long-term assets, including those corporate loans we've been talking about, but then depositors wanted their money. And those assets, yeah, not so easy to cash in quickly.
So we've got these big, risky corporate loans that are often illiquid. What else makes pricing these things so tricky, even for the people who do this for a living?
Well, believe it or not, banks actually consider relationships when making these decisions.
They do.
They do. If they have a long-standing relationship with a company, that can play a big role in whether they're willing to offer them a better deal on a loan. So it's not all just numbers and algorithms. There's a human element that adds another layer of complexity.
It's more than just plugging numbers into a spreadsheet.
100%. And then on top of that, every single one of these corporate loan contracts is basically handcrafted.
Wow.
It's completely different from those standardized mortgages we talked about. With corporate loans, you see this massive variation in the terms, the covenants, the whole structure of the deal. It can be incredibly complex.
So every single loan agreement is like a tailored suit. It's made to fit the specific borrower and the risks involved.
You got it.
That's got to make it almost impossible to figure out what a fair market value even is.
You're telling me.
Yeah.
And then you add in these confidentiality clauses, which are super common in these agreements.
Right.
So you have a real lack of transparency, which makes it even harder for a bank to sell or trade a loan if they need to.
So we've got these complex relationships, unique contracts, confidentiality issues, and we haven't even talked about monetary policy.
Oh, yeah, we can't forget about monetary policy. Corporate borrowers, they feel the impact of interest rate changes and what central banks are doing way more than the average person. That adds another layer of complexity for banks when they're figuring out these loans.
It's crazy how all of this stuff is connected. So if banks have to deal with all of these challenges when making corporate loans, how on earth do they manage their liquidity so they don't lose their shirts?
Now, that is the million-dollar question, isn't it? And that, my friend, is what we are going to dig into next.
We're back, and we're really getting into the weeds now with these corporate loans and how important liquidity is. It seems like banks are constantly walking this tightrope.
It really is a balancing act.
They need enough liquid assets, right? But if they have too much, that's not good either.
Exactly. Having plenty of liquidity, it definitely lowers risk. But it can also send a message that the bank isn't being aggressive enough with its lending.
Like they're sitting on a pile of cash instead of putting it to work.
Right, and that can make investors nervous. They might see that as a sign the bank isn't doing as well as it could be.
Which can hurt the bank's stock price, not to mention its overall reputation.
Exactly. And then we can't forget about the regulators. They've got a lot to say about how banks manage their liquidity, which of course ends up impacting the prices they offer on loans.
Oh, absolutely. I mean, we saw what happened back in 2008. After that whole mess, regulations like the liquidity coverage ratio, the LCR, and the net stable funding ratio, the NSFR, they became the law of the land.
And for good reason.
Mhm.
Those regulations, they might make things more complicated for banks, but they're crucial for preventing another meltdown.
Right. They add to the cost of doing business, but they also make the entire financial system safer.
Exactly.
Mm.
And as you might expect, those added costs often get passed along and built into the interest rates on loans.
So it's this incredibly complex web. You've got those relationships we talked about, the unique contracts, monetary policy, and now these regulatory requirements. It's enough to make anyone's head spin.
And as if all that wasn't enough, we're right in the middle of this technological revolution, which has been huge for finance. But it's a double-edged sword when it comes to liquidity and loan pricing.
It's amazing, isn't it? AI, predictive analytics, instant information. It's like the financial world suddenly got this massive upgrade.
It really is. But the big question is everyone ready for this?
Are they up to speed?
Right. Take AI-driven credit scoring, for example. That's a complete game changer. Instead of just looking at traditional credit history, algorithms can now analyze massive amounts of data and find hidden risks and opportunities that humans would probably miss.
It's like having this financial detective with a superpowered magnifying glass, spotting all these tiny little clues.
And what's amazing is that this has a direct impact on how loans are priced. Banks can use these more accurate risk assessments to fine-tune their pricing and better reflect how likely a borrower is to actually default.
So, in theory, this should make the whole system fairer.
It should.
Less guesswork, more data-driven decisions. But you mentioned instant information earlier, and we both know how quickly things change in the digital world. Doesn't that create a whole new set of vulnerabilities?
Absolutely. The same tech that allows for these faster, more precise risk assessments also means that information, whether it's good or bad, can spread through the market much faster.
It's like that game of telephone, but instead of a whispered phrase getting distorted, you have financial data being analyzed at warp speed.
And the stakes are way higher.
Hmm.
This rapid-fire flow of information can really increase volatility and make those liquidity pressures even stronger.
Silicon Valley Bank is a perfect example.
That's right. Technology might not have been the only reason they collapsed, but it certainly played a role in how quickly things fell apart. For sure. It's a whole new world of risks.
Things change so fast. 1 minute a company's stock is through the roof, and the next it's plummeting, all because of something someone tweeted or a video that went viral.
Exactly. Technology can help banks manage risk and improve how they price loans, but it also has this potential to make liquidity risks even bigger.
It's both a blessing and a curse.
That's a great way to put it.
We've been talking about the big picture stuff, liquidity in the financial system, the role of banks, how technology plays into all of this. But what about the actual contracts for these loans? What about the fine print? Are there things built into those agreements that can help reduce some of these risks?
You're right. We need to zoom in and look at the details. And that means talking about loan covenants.
Loan covenants. So like the terms and conditions we all scroll through online without reading?
They're kind of like that, but way more important. Loan covenants, they're legally binding promises that the borrower makes to the lender as part of the loan agreement.
So they're designed to protect the lender, make sure they don't get left high and dry.
Exactly. A covenant might require the borrower to maintain a certain level of profitability, for example, or it might limit how much more debt they can take on. Things like that.
To keep them from getting in over their heads.
Right. And here's where things get really interesting when we're talking about liquidity and pricing. Some covenants are linked to a company's financial ratios, like their debt service coverage ratio, or DSCR.
Now, for those of us who don't spend all day staring at financial statements, remind us what that ratio tells us.
Of course. The DSCR, it basically measures a company's ability to use the cash flow it generates to cover its debt payments. Generally speaking, a higher DSCR is better because it tells you the company is in a better position to pay back its debts.
Got it. So if a company has a strong DSCR, it's less likely to default on its loans. But how do covenants fit into this?
Well, here's where things get a little crazy. Some loan agreements have covenants that actually prevent a bank from changing the interest rate on a loan, even if market conditions change or if the borrower's financial situation worsens.
Hold on. So even if a bank starts seeing warning signs, like interest rates are going up or the company's industry is struggling, their hands might be tied because of a covenant.
That's exactly right.
It's like a double-edged sword for banks. Covenants offer some protection, sure, but they also take away some flexibility when it comes to responding to changes in the market.
It's all about finding that sweet spot, managing risk, but also trying to get the best returns. That's the game in finance.
Absolutely. We've covered so much ground. The challenges of corporate loans, how important liquidity is, the impact of regulations and technology, and now these loan covenants. But we haven't even touched on the different economic theories that come into play here.
You're right. We still need to talk about that and how different economic schools of thought view this relationship between liquidity and loan pricing. Plus, we've got to give our listeners some practical advice.
Yeah.
What can banks actually do to navigate this crazy landscape?
That's the perfect way to transition to the final part of our deep dive. We'll be back to tackle all of that and more, so don't go anywhere. And we're back, ready to wrap up our deep dive into the fascinating and, let's be honest, sometimes confusing world of corporate loans, liquidity, and how those loans get priced.
It's been quite a journey, hasn't it?
It has. We've looked at all the moving parts, all the things banks have to juggle when they're dealing with these kinds of loans, and now it's time to bring in some economic theory.
Because, of course, no discussion about finance is complete without a little economic theory.
Exactly. We're going to put on our economist hats, or at least pretend to, and look at how different schools of economic thought view this whole relationship between liquidity and how loans are priced. It's like we're seeing the same thing through different lenses.
That's a great way to put it. So where do you want to start?
Let's start with the classics, the original gang.
Right, the classical economists.
Yeah.
The folks who really believe in free markets and the power of the invisible hand.
Exactly. They're all about letting the market do its thing. Less government interference, more reliance on those basic forces of supply and demand.
And when it comes to liquidity and loan pricing, classical economists, they tend to see those market forces as the main drivers. If banks have a lot of liquidity, they're more willing to lend, and that pushes interest rates down. But when liquidity is tight, banks get more cautious, and that means loan prices go up.
It's like a seesaw, right?
Exactly. The classical view is all about finding that point where the supply of money that's available to lend meets the demand from borrowers.
It's all about that equilibrium. But then you've got the Keynesians, and they see things a little differently, don't they?
They do. Remember, Keynesian economics is all about the role of demand in driving economic growth. Keynesians believes that the government has a really important role to play in managing the ups and downs of the economy.
Right. When the economy is weak, governments can step in and give things a boost. Think infrastructure projects, tax cuts, things like that.
And from a Keynesian perspective, liquidity is super important because it influences how willing banks are to lend money in the first place. If the economy is in a slump, Keynesians might argue that the government should implement policies that pump more liquidity into the system, basically making it easier and cheaper for businesses to get loans, invest that money, and ultimately help the economy recover.
So in that kind of situation, you might actually see prices for corporate loans go down.
You could. If banks have more incentive to lend, they might be willing to lower their rates to attract borrowers.
Makes sense. Now, what about the monetarists? What's their take on all of this?
The monetarists, they're all about managing the money supply to keep inflation in check and keep the economy stable.
Right. If I remember correctly, they believe that central banks, like the Federal Reserve here in the U.S., should focus on making sure the amount of money in circulation stays relatively stable to prevent inflation from getting out of control.
Exactly. And that's where liquidity comes in. When central banks increase the money supply, you typically see more liquidity in the banking system, which can lead to lower interest rates, even on corporate loans. But if they tighten the money supply, well, that usually means less liquidity, which puts upward pressure on those borrowing costs.
So just to recap, we've got these three main schools of economic thought: classical, Keynesian, and monetarist. And they each have their own way of looking at how liquidity impacts the pricing of loans. It's not about one being right and the others being wrong. It's about understanding these different frameworks, how they might shape policy decisions, and even how they influence what banks decide to do about lending and interest rates.
It just goes to show you how complex and dynamic the financial system really is. It's constantly changing.
It really is. We've covered a ton of information today, from the very basics of corporate loans to the big picture economic forces that shape how they're priced. But before we wrap up, I want to bring it all back to our listeners. If you're in the finance world, or maybe you just want to understand what you're hearing on the news, what are the key takeaways from all of this? What can banks actually do to manage their liquidity in this crazy environment?
That is the million-dollar question. And honestly, there's no one-size-fits-all answer when it comes to managing liquidity. Every bank has to find what works for them. They have to look at their own risk tolerance, how they do business, and what's happening in the market.
It's like trying to find a suit off the rack that fits perfectly.
It just doesn't happen. Banks have to be really strategic. They need to understand their loan portfolios inside and out. They need to know, what industries are my borrowers in? What do those loan covenants say? How financially sound are these companies? It's about finding that balance, having enough liquidity on hand so they can meet their obligations, but not so much that it stifles their lending.
And of course, we can't forget about technology. AI, automation, predictive analytics. Banks have all these incredible tools at their fingertips now.
They do. But we can't forget that technology is just a tool. It can be incredibly powerful, but banks need to use it wisely. Don't rely on it too much, and never forget that human judgment is still essential.
Use the tools. Don't let the tools use you. It's all about balance.
Couldn't have said it better myself.
Yeah.
And lastly, it's crucial to stay informed. The regulatory landscape is always changing, just like those economic theories that influence policy. The name of the game is adaptability. Be ready to adjust, be ready to learn, and you'll be in a much better position to navigate this world.
So to sum it all up, find that balance, use technology wisely, and never stop learning.
Well said. It might be a wild ride, but those who can handle the complexity, those who can adapt, they're the ones who will succeed in the world of finance.
And on that note, we've reached the end of our deep dive. It's been quite a journey, and we hope you found it as informative and engaging as we have. The financial world is complex, but we believe that understanding it, even just a little bit better, can empower all of us to make better decisions. Until next time, this has been The Deep Dive.